Hello, rookie bloggers. It's Coach Holmes here. As promised last week, I was going to do up a little video. We've been talking about the inverted yield curve, kind of had an in-depth explanation of it last week of the concept and what it really means to us, what it means from the perspective of, is it just something else that's neat to look at, or is it just another piece of fundamental data that, it really doesn't have a lot of meaning. We don't want it to be that. We want to use all the tools at our disposal when it comes to getting a feel for the markets, and that's essentially what we're doing when we look at things like the inverted yield curve. When we're looking at our technical analysis, we're trying to get in tune with the markets. Okay. And so the inverted yield curve becomes very interesting because in the last couple of crashes, market cycles, whatever you want to call them, um, there's some fundamental and technical things that happened that basically I don't want to say they foreshadowed an event, but it's curious to note that certain things happened in certain patterns in certain manners. So I'm gonna go quickly over that tonight, and this will just be, like I said, I kind of promised to do a video last week, so that instead of just reading the words, you kind of get to see a bird's eye view of what we look for and why we need to pay attention to these things. Okay, so let's start with the dynamic yield curve itself. If you go to stockcharts.com, you can put in the search area there, dynamic yield curve, and you'll get to this tool here. Okay, and essentially what this tool does is it shows you when the yield curve actually changes. Okay, so we'll go back all the way back to probably 1999, 98 here. Okay. And so, as I explained in the blog last week, you've got basically you got an interest rate here of probably about 4.5% on the 3-month bond, and you've got probably somewhere in the neighborhood of 5% on the 30-year bond. Now that is a normal, as you can see down here, that's a normal condition. So that's January 1999. Okay, that is a normal condition. Typically, if you're going to lend money and you lend it for a longer period of time, you're going to want a better yield out of that. You're going to want more money from it. Okay, and so that's what a yield curve does. Well, sometimes what happens is the shorter term bonds end up getting a higher yield than the longer term bonds, and that's called an inverted yield curve. Okay, and so what that can represent is, and it depends on who you talk to, that signals the next recession, or it signals the next, whatever, right? For us, what it means is it's a signal for us to kind of pay attention. Okay, so I'm going to show you a couple things that I think are kind of neat here. So I'm going to get to a point here. I'm just going to animate this thing and try and stop it when it inverts. Flat, flat, flat. Oh, okay. So you can see down here that it says inverted. It's kind of not really showing me exactly what I want, so I'm going to animate a little bit more. Okay, we're getting closer there. Okay, so you could clearly see that here the interest rate is higher than it is here. Okay, so this poses an interesting question. So what does that mean to us? Well, you can see that this was right around the 2000 mark. Okay, so we all know about the tech bubble of 2000. We know about the crash, right? It was preceded by this inverting of this yield curve. Like I said, this even tells you it's inverted here. This is April of 2000. It tells you that it's inverted. That this is not a normal condition. Okay. Now, does that mean we go out and we sell all our stock and we back the truck up and buy all the puts we can? No, that's not what it means. Okay, and so this is what I was talking about in the blog. There's other things we got to look at. Okay, and we're going to look at it on a better chart, but you can see here that we actually we end up, this actually tells us this in April of 2000, but the crash doesn't actually come, or the downside of this doesn't actually come until right about there, which is actually August of 2000. Now you can see that it's super inverted here. Okay, now you're not always going to see this. It's not going to be always as clean as this one, but you can see that we're right at the precipice here before this takes a pretty big nosedive. Okay, so there's a couple things. We have a year inverted yield curve. Well, does that mean that obviously it's going to fall? Well, we can see this in hindsight for sure. It's right there in the chart. Okay, but there was more to this than just this inverting the yield curve. We got a double top. This is your fundamental, if you will. The yield of bonds is a fundamental piece of data or fundamental statistic, whatever you want to call it, right? It's a fundamental economic indicator. Okay, but we've also got technical indicators here. You can see that we're basically putting in a double top here. Okay, and this is a double top on a major chart. This is on the SPX. Okay, and we're going to look at this in more depth because some other stuff we want to look at. But just know that when this inverted yield curve, when the curve inverted at this point in time, we saw it following a crash. Well, let's kind of move forward a little bit here. Okay, and let's fast forward to, because we know there was another crash in 2008. So you can see here, that thing popped up. I don't know why that did. Anyway, you can see here that, oh, sorry, I messed that up for you. Let's get back to here. So you can see here that the curve it's normal. Okay, it even says normal down here, and you can see that the shorter term is longer. So it's just inverted there. Okay, so now it inverted here, but what happened? The market continued up. Okay, so even though it just inverted, let me see if I can get it back to the point where it inverted here. Let me get right. Let me animate it again. Right there. So you can see that it inverted right there. Well, that didn't mean that it was a big crash, right? But what it did mean was, okay, now that it inverted, maybe we should be looking for something else. Okay. So in this case, we have a lot of time here. This is February of 2006. Okay. So this is a long time before the crash of '08. Well, there's a couple other things we're looking for. So this thing's flat, 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 kind of inverted flat. Now it's more inverted there. They call it flat down here, but it's definitely inverted. You can see it there. Okay, so it's inverting again. It's flat, flat. Okay, and let me pause it right about there. Okay, so now it's gone back to normal, but what are we seeing here again? Well, look at this. We're at another double top in a major market here in the SPX. Okay, and that's when we get this fall again. Okay, so what does that mean to us? Well, what that means essentially is that a couple of weeks ago, the yield curve, okay, in this particular case, the 2-year bond got a higher yield rate than the 10-year bond. Now you're not going to see it as well in this chart, but if you go back and you look at any of the metrics or any of the news items, you'll see that it actually did invert. So I'm going to try and animate it here the best I can. And I'll see if I can stop it right when it does what I want it to do. Oh, see, I missed it. Very hard to see here, so we'll try it again. And it's right about, like I said, it's not easy to see on this chart. But you can already see here that this 3-month is now higher than the 2-year and then higher than the 5-year. And unfortunately, it doesn't show it very well on here. But it actually, the 2-year actually got higher than the 10-year at one point in time there. Okay, so what does that mean? Well, that doesn't mean anything right now other than, hey, maybe let's take a look at something and see if some other things happen. Okay, so let's look at the big charts here, and I'll try to explain a little bit more of what I'm seeing here. So if we look back here, we'll go back to 2000. Okay, so we look at it, you can see this is the year down here, 2000. Actually, I'm going to get the drawing tool out here, make this really easy for you guys to see. Let's take this here. Let's get a nice bright color. Let's go with the yellow. Okay. So what we have here is the year 2000, and it was August of 2000 when it started to drop, which falls pretty much in line here. Well, what we can see here, I can draw a straight line here, is you've got your double top right there. Okay. So the market popped up. Now this is a 20-year monthly chart. Okay. So this is a monthly chart. So every one of these little candles here is a month. Okay, now if we see something on a monthly chart, we naturally have to give it more credence than if we see it on a weekly chart or a daily chart or an hourly chart. It means more because it took longer to create whatever patterns we're seeing. Okay, so in this particular case, like I said, we've seen this pop up, it pulled down, okay, it popped up again, and then it started to drop. Okay, so we got actually not only a double top, we got our first M for murder pattern here. Okay, so in April we saw the inverted yield curve, the yield curve invert, and then in August we saw this formation take hold, this double top. Okay, and so all of a sudden we've got a recipe here. We've got a couple things now. We got the yield curve, we've got the double top, and there's one more thing that we can look at. I'm going to get rid of this drawing here. there's one other thing here. I don't know if you guys can see this real well. But right there, this is the 10-month MA crossing over the 20-month MA. Okay, so this is a shorter time frame crossing over a longer time frame. This is a bearish sign as well. So we got three things now. We got the yield curve, right? Yield curve. We got the M pattern or the double top, and now we got the moving average crossover. Okay, so now we have three things all lining up, and sure enough, if you'd just been watching these things happen, you can see that this 10 MA monthly MA stays below this all the way until this crossover here, down here, and that was in '04. That was when it started to recover from the year 2000. Okay, so this is the kind of stuff that we want to pay attention to. Okay, now does that mean we're in that spot now? No, not necessarily, but I will show you in a second how things are starting to line up. Okay, so now let's fast forward to the crash of 2008, the subprime mortgage. Right, everybody remembers that one, right? Well, look at this. Okay, we looked at that on our dynamic yield curve, and sure enough, it actually in 2006 it inverted, and it stayed inverted basically through all of this. Okay, all right. But what it did was it kind of gave us a heads up well in advance, right? Well, look at this. What do we got here? Look at that. Another double top. What do we got here? Well, that sure looks like an M for murder pattern to me. Okay, this would be your neckline here of the bottom of your M. And look at, lo and behold, we got a crossover there as well. Okay, so we got all these three things lining up, and lo and behold, this thing went down there and it stayed below there right up until this cross above it. And remember, it's the monthly crossovers. That's a big deal. Okay, so that's two in a row we've seen. So now we know that just recently in the last couple of weeks, so they'll be here, that the yield curve inverted. Now it didn't invert fully as we saw. The 3 months didn't go over top of the 30-year, but the 2 did invert over the 10. Okay, so maybe that's a sign to say, well, maybe we should be paying more attention to this. Okay, so right now you can see that we had a high in I believe that was that October of last year. It's hard to tell here. I think it was October of last year where we started to have this pullback here. So we've got a spot there. Well, right now we're very close to that spot. We're very close to putting in another high, an all-time high on the S&P 500. Well, maybe it continues up this way, right? Or maybe it turns down this way. We don't really know. Okay, we have to kind of, watch our technicals and see how it goes. But could this turn into an M pattern? I think it could. Kind of looks like one to me right there. Now, does this mean I'm getting short? No, absolutely not. That's not what it means. What it means is we've had a couple of things go on, but what we want to do is we want to stack all this stuff in our favor. So if this does happen to make an M pattern, okay, maybe it breaks out to new high and doesn't make a double top, and that's fine. If it doesn't, well then we're not seeing what we did before. But if it does happen to make an M pattern and this 10 crosses over this 20 again, and we break this neckline down here, probably the 250 mark in the SPY, right? Or sorry, yeah, it'd be the 2500 mark, I guess. Then maybe it makes sense that we're due for another pullback. Okay. And so this is really what that means. It's not a thing to go out and scream the world is falling, the sky is falling, all the Chicken Little kind of stuff. That's not what it's meant to do. What it's meant to do is it's meant to give us a heads up, and so that we can pay attention to these technicals, right? All right, pay attention to the technicals. Are we getting the same scenario again? This is what we do as traders. We look for patterns. Okay, so maybe this pattern's playing out, and maybe it doesn't play out at all. We don't know. But the inverting of the yield curve gives us an opportunity to pay more attention than maybe we're used to paying. Okay, and so that's really what the inverted yield curve is all about. It can signal another recession. We've seen on the last two major market corrections that they kind of lined up the same. Okay, and we've had a pretty extended bull run as well. There's a whole bunch of things that you could add up to say, okay, maybe this thing's ready to turn. But until it actually does that, we as traders have to react and not predict. I'm not predicting anything here. What I'm saying is I'm paying attention to this formation. Okay, and I'm not the only one. A lot of traders are paying attention to this. So this is what the yield curve is all about. I hope that was a good explanation for you. You guys can kind of see it in the charts now, kind of see what I'm seeing, and just something to pay attention to. Okay, we've got lots to pay attention to as traders. This might be one that you want to put on your list. All right. So that's a rookie blog for this week. Hopefully that was educational, and we'll see you guys all next week. Take care.